Hey everybody, welcome back to another episode of the Blockware Intelligence YouTube channel. It's Will here, and as always, we're going to be going over some key market trends that you should keep in mind from the week. It's been a nice little week so far for Bitcoin. We broke above 60K. When I wrote this, we hadn't broken above 60K yet. But yeah, it's some nice little price action we've gotten here. I think, in the short term, we've gotten a lot of leverage late longs here. I've hopped in, and I wouldn't be surprised if we get a bit of a pullback. But then again, the market's been pretty unforgiving with dips it's been giving out. Last week we touched on some of these trends that we're going to be just looking at continuation of, and also maybe some new things that we haven't yet mentioned here on the channel. So first of all, we just have these price levels, right? These are the price levels we've been looking at for weeks. The last we've talked about is the last major resistance between 56 to 58K has been broken. And obviously would like to see that be retested and flip as support below us. But I remain bullish as long as we're above this point of breakdown for May, which is right around 50K actually. So from an on-chain perspective, the first chart we have is the UTXO realized price distribution, aka URPD. This is looking at the amount of Bitcoin that is moved at each price level on the chart. So if you have a coin that's last moved down here at 1100 and is then moved again at 60K, well, now the coin is moved from this bar to this one. So it's showing you where coins have last moved at each different price level. And so what you see here is that we only have at the time of writing, it was 0.68% of supply. So this little amount of supply here that's still above us. And so, pairing that with price structure, there really isn't too much resistance above where we currently are. So this is overhead supply we're talking about. We've chewed through a lot of this on-chain volume over the last month or two. And so, once we can get above this final bar volume, obviously we'll be in price discovery and there'll be no overhead resistance. So it's just blue skies from there. But we're right on the edge, guys. So close yet so far away. Huh? Nothing has changed with SOPR. We just like to throw it in every week so people are aware, because I think this is one of the best metrics to look at on this, kind of day-to-day, week-to-week basis. So here we're looking at weekly SOPR. Usually I throw in a SOPR, which is the adjusted version. So looking at, filtering out the outputs below 1 hour. This is using ND adjusted, so just a bit different of a methodology for it. But you'll see we bounced, at the end of last year after this 20% correction in September, right off of one, and then we saw continuation up into the main phase of the bull market. And then we got this bearish divergence with SOPR against price. We came back down, broke below, and then as we always talk about, guys, like, in a broader bearish trend, you want to fade the retests of one, whereas in a bullish trend, you want to buy the dips along one. And so we got this failed, retest, aka, the one served as resistance, and we bounced off of that. Once we broke above, that's a saying we're back in a bullish trend, but you don't have confirmation until you get that retest, which we got a few weeks ago, of that one threshold serving as support. So now we've started to move higher. Would ideally like to see continuation, but if we get a price correction, which I think we look a bit overextended, so I wouldn't be surprised if we did come back down and look for a bounce along that one threshold. And then, or at the minimum, just stabilizing above. What you don't want to see is what we saw over the summer, break down below one, obviously, and then coming back down and retesting that as resistance. So next, we're looking at the futures term structure. So what we're looking at here is all the different major exchanges: Binance, Bybit, Deribit, FTX, Huobi, OKX. The one that isn't included and is actually pretty relevant to the market lately has been the CME curve. What you see is that aside from Huobi, all the major exchanges are in contango, meaning that the futures curve is positively sloping, and each time, so each time, when you go out, so 1 month, 3 month, 6 month, they're all trading higher than the previous. So each contract, when you go out further on the curve, is trading higher. And then a backwardation would be the opposite, right? So each contract is trading lower, you have a negative sloping curve. And so this is important because it opens up the opportunity for market participants to participate again in the cash and carry trade. This was at the beginning of the year. I'm sure everyone remembers contango, contango, contango. We are actually, starting to see that annualized basis start to pick up a bit. It's back up to about 14.2%, whereas over summer it briefly dipped below 1, which, by the way, whenever the basis dips below 1, that's been a great buy opportunity. And so what this is showing you is that you can buy spot and then sell the 3-month contract, 3-month futures contract, and capture 14.18% annualized, essentially, risk-free, or you have no directional bias in your position there. And so, for overseas exchanges earlier this year, these active managers were able to just capture this yield, which got up to 45% at the peak of the bull market. But where it gets interesting with this whole futures ETF thing is, I'm not an expert per se on that, but if the CME curve starts to get bid up, that could open up capital that wasn't able to access this trade from earlier this year from the US. Whereas, most of the capital that was pouring into the cash and carry trade was from overseas. And that's because, regulatory restrictions, in the US here, we can't get access to some of these exchanges because of the leverage that they offer. And so, like, starting to see the CME curve get bid up would also open up this arbitrage opportunity for US active managers as well. Another trend that's been interesting to follow in the derivatives market has been the percent of futures open interest that's margined with crypto versus stable coins or cash. And so what you see is that right around May, we had this big drawdown, and this was because we had been pretty much up only for like 6 to 8 months. And so the reason you would want to be margined with crypto versus stable coins is because, as let's say you're margined with Bitcoin, as Bitcoin's price is going up, your collateral is also increasing in value alongside of that, right? Which is great when Bitcoin's going up. But as soon as Bitcoin starts to reverse, you have this really large convexity in the market, which is just a fancy term for just saying, as the price is going down, as your P&L is going down, your collateral is also going down. So you're less margined for the position that you're in. And so it has kind of this negative feedback loop, right? And so that's what we saw in the late May. You had a lot of coin margined futures that got wiped out. And since then, we've seen the market just continually, like to use stable coins over crypto margin futures. And so this means two things. So first of all, we talked about the convexity. So seeing this drawdown leaves us less susceptible to these large moves, right? So there's less, potential convexity if we have a move down in the market. And then also we're actually more susceptible for short squeezes because, similar to as we talked about, if you're long and you're margin with Bitcoin, as price moves down, your collateral is decreasing in value. If you're short with stable coins and the price starts to go against you and starts to go up, well, not only is your P&L going down, but actually you're less collateralized as well in the same sense. So if you're a margin with BTC, if you're margin with BTC and price starts going up, you basically have this like inadvertent hedge, right? Because the trade is going against you, but your collateral is increasing. So, as it's going against you, you're better collateralized actually. But with stable coins, you don't have that. So it's basically leaving these market participants more susceptible to getting short squeezed. And so I suspect if we start to reach price discovery that you'll start to see this tick up, and you'll probably start to see people get more bullish and more BTC margined or crypto margined futures, enter the market. But for now, I think we're overall in a pretty good spot. Ideally, you would love to see this tick downward, but I think if you start to see higher prices, you'll probably start to see more crypto margin futures come in the market. Next up, we're just looking at all the volume and then subset into different size. So we're looking at, $0 to $1,000 transactions, all the way up to $10 million plus. What you see is throughout 2020, we saw an increase in large transactions dominating overall volume. And that's just reflective of, institutional capital in the market. And then over the last month, though, we've seen this large increase in specifically $10 million plus transactions. You'll see this in this black box here. To me, this is representative of two things. So probably exchange batching, but primarily like large institutional, OTC transactions. So basically just saying whales are really active in the market. And this is also reflected in our entities data. So here we're looking at, in the blue line, we have our plebs. These are the 0.1 to 1 BTC entities. And then we have the purple line, which is 100 to 1,000, and the green line, which is 1,000 plus. So we're looking at all the large whales, filtering out for exchanges, QBTC, Grayscale, all those known entities. So what you see is they've been buying really heavily since July, as we've been tracking, but they actually started taking profits over the last month. However, the purple line is the 100, as we mentioned, the 100 to 1,000 guys. They've been in pretty much decline since May, but we've actually started to see them pick up. They're buying over the last month and offsetting some of the selling from the really large whales. And so between the two, yes, you've had the large whales selling, but you actually have a net accumulation between the two. And so in general, what you've seen is since July, you have large buyers that have been active in the market. That's reflected here, and then also with the transfer volume breakdown here. Next up, we have our transactional activity. For this, I wanted to use active entities this week, but you can also look at transaction rate, transaction count, look at the mempool, all these different kinds of things, fees as a proxy for demand for block space. And what you see is I threw this on a 14-day moving average. We're starting to see that pick up a little bit, but overall, we're still nowhere near where we were earlier this year. And this pairing it with Google search trends, which is a pretty wide known one, but also Coinbase app downloads. I think you can make a really sound argument that retail hasn't entered back into the market. I mean, also we looked at volume is dominated by whales, right? And so all these things to me are showing that the speculators haven't really fully stepped back into the market. And so, I suspect that that'll probably start to pick up if we break all-time highs, right? Next up, we have our long-term holder supply shock ratio. We looked at this probably for weeks now. Essentially, what you're doing is comparing the short-term guys to the long-term guys by running a ratio between the two. And the idea here is when long-term holders lock up a certain portion of supply, they essentially set the floor, and then you get a supply squeeze effect in the market. And what you've seen is, we had entered that green box over the last couple of months, as we've been looking at, but we've now in metric discovery, if you will. We're in all-time highs for the ratio. So long-term guys have really been locking up coins, but I suspect over the next month or so, you'll probably start to see this decline. The way I see this is once long-term holders have locked up a certain portion, you start to get the momentum in the market and, increases, and then it takes a life of its own as reflexivity kicks in. And then the long-term guys can start to sell as they have historically, bought weakness, sold into strength. So don't be surprised if you start to see this tick down, as well as whales. Whales generally buy the weakness and then start to sell into strength. So we'll keep an eye on those things. But I don't see that if this starts moving down as an entirely red flag per se. But we have reached all-time highs in that. So long-term holders have really kind of set the floor. Then lastly, we're just taking a peek at miner related data. So in the green line, we have miner balances. In the orange line, we have hash rate. And then in the blue line, we have revenue per hash in USD terms. So this is important to understand the difference between revenue per hash in BTC and USD terms. So when hash bottomed out, you had all these, the Chinese miner migration, all these, rigs getting pulled off the network. And so the miners that were still left on the network were extremely profitable in BTC terms at the time. But since hash has come back on the network, as you have more competition for that, the same block reward, revenue in BTC terms has gone down. So basically inversely to hash coming back on the network. But in USD terms, because of Bitcoin's price appreciation, that's held up pretty strongly. We're actually near where we were earlier this year, and briefly in August. So we're still in a good spot for miner profitability in USD terms. Overall, you've seen miners accumulating. They were accumulating pretty heavily. As we after after that Chinese miner migration, and the miners that were still left on the network were really profitable. But you saw them take a bit of profit over the last month or so, and since then they've started reaccumulating those coins. But yeah, that's what's going on with miners. Still bullish hash over the next couple months. Yeah, guys, be sure to check out Blake's section as always in the bottom half of the letter. And the podcast should be out on Sunday, I believe. Recorded with Dylan this week. We just chopped it up for about an hour. So hoping you guys enjoy that. We talk about all things on chain, just broader market. I mean, everything. So hopefully you guys enjoy that. And yeah, looking forward to touching base next week. And take care, guys. Bye.